Imagine waking up tomorrow to discover that every man, woman, and child in America owes over $100,000. You didn't buy a house, and you didn't take out a loan. The government borrowed it on your behalf. This animated bar chart shows the top line number, $35 trillion. That figure defies human visualization. It completely dwarfs the combined annual economic output of many global superpowers. Experts look at this number and heavily disagree on what happens next. Some call it a ticking time bomb, guaranteed to trigger an economic crisis, while others shrug it off as perfectly normal and nothing to worry about. The confusion comes from how we think about money. Most people treat the national debt like a massive household credit card bill, assuming the total will eventually come due all at once and plunge the country into bankruptcy. Add to that the popular rumor that foreign adversaries own these IOUs and are waiting for the perfect moment to foreclose on the United States and seize its assets. The prospect of a sudden, cataclysmic bankruptcy remains a mathematical myth. Instead, $35 trillion creates a persistent structural pressure that steadily erodes the nation's financial health over decades. Every time the United States government spends more money than it collects through taxes, it creates a budget deficit. To bridge that gap, Washington has to borrow money. Throughout history, severe economic recessions and financial panics have forced the government to borrow heavily just to stabilize the system and keep the economy moving. Recent emergency events push that borrowing into overdrive. To fund pandemic relief programs and prevent a larger disaster, the government added trillions of dollars to the debt in a very short amount of time. When the government borrows money, it takes the physical form of treasury bonds. Investors buy these IOUs with cash, and the government promises to pay them back with a return. The true primary creditors holding those bonds aren't foreign countries. They are American retirement funds, mutual funds, local banks, and millions of everyday citizens. Because the country largely owes this money to itself, any theoretical default would instantly wipe out domestic savings and pensions, crippling the nation's wealth from the inside out. America holds a unique macroeconomic advantage. The US dollar operates as the world's dominant reserve currency, meaning nearly all global trade relies heavily on dollars to function. Because of this global demand, the government controls its own money supply. It can issue bonds and, through its financial system, effectively create additional dollars, making a traditional bankruptcy practically impossible. This pie chart of the total federal budget shows the actual mathematical danger. The principal balance isn't the immediate threat. The cost of the interest payments on that balance is. As the total debt grows and interest rates rise, the government must spend thousands of dollars every single second simply to service the existing debt, without ever reducing the principal balance. Every dollar spent paying down interest is a dollar pulled away from vital domestic sectors. That means less funding for building infrastructure and maintaining education systems. It also drains critical funding away from national healthcare programs and limits the budget for national defense. This mounting debt acts as a financial vacuum, systematically diverting capital away from the public programs that maintain the country's basic functions. If the government struggles to cover its interest payments through taxes or new borrowing, the financial system may be forced to effectively create more dollars to keep the system liquid. Flooding the market with these new dollars reduces the value of every existing dollar, leading directly to inflation. This process acts as a silent tax. It alters the financial reality of the country without a single lawmaker ever voting to pass legislation. Consumers feel this silent tax immediately. It raises everyday prices, drives up living costs, and steadily destroys the purchasing power of their savings. Looking ahead, economists see three potential paths. In the first scenario, American economic growth wildly accelerates, allowing tax revenues to organically outpace the debt. In the second path, the government introduces severe austerity measures, drastically slashing public spending to forcibly control the deficit. This line graph tracking debt to GDP ratios shows the most likely third path, inaction. Without strict intervention, interest costs climb, and the debt burden expands exponentially into the coming decades. $35 trillion means a generational squeeze. Tomorrow's citizens are inheriting the bill for yesterday's crises, forcing future generations to lower their standard of living simply to pay for the past.